I see it on our social media account all the time. People go, "Oh, there's a correction coming. The big sell-off's about to happen." And the first question I ask people when they post that on the feed is, "Great. How are you positioned short yet?" None of them are. They're all experts. "Oh yeah, it's going to crash." And look, markets do crash. As to when, well, a broken watch is right twice a day. And if you keep saying it's going to crash, one day you'll be right. But if your view is it's going to crash, you've got to profit from that. You always have to seek to profit from your view because it's an enormous validation, confidence builder, financial asset builder, and so on and so forth. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at phases, cycles and trends, the big pictures in markets, and more importantly, understanding how to be able to exploit them for your own gain. Lots to take out of this because everyone watching this will have a different perspective on how markets work and what their time frame for investing might look. Make sure you take plenty of notes. Most importantly, make sure you take plenty of action. We'll see you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Good to be here, AB. Thank you for having me. Now, topic of discussion for today. One of the many challenges that we face trading markets is, of course, understanding phases that the market's in and also cycles. So for our listeners today, we're going to go through effectively how to read the tape.
Important skill to have, and particularly when you've been through a bit of turmoil. You know, a lot of people are a bit battered and bruised when markets sell off, which is a factor of investing in a potentially volatile asset. So breaking it down, the three big shapes in markets. So there are phases, there are cycles, and then there are trends. And if we talk about phases, that could be a bull run that's a 10 or 15 year secular bull cycle, or indeed a secular bear cycle. You know, if you look at the US through the late 60s, probably 1970 through to probably the early 80s, that was a secular bearish market. It was very, very hard for the market to move higher through that period of time. You had inflation, you had interest rate dramas, you had the oil shock, and also very, very high labor costs in the US and high unemployment. So, that was a period that was pretty tricky over a long-term slab to look at. And then you sort of look through other lenses. You had the great bull run up until the 87 crash. You had a terrific secular run for the best part of a decade. There was some volatility in there through the 90s. And again, that first 7 years of the 2000s leading into the GFC. So that's what I would call that really expansionary phase. And it usually aligns with major fundamental economics. And I know we're talking about reading the tape, which is technical analysis in its essence, but those big phases are really accompanied by structural shifts within an economy.
So as to where we are right now, just for context for our listeners, how would you describe the market phase?
We've been in a fairly strong long-term bullish phase, and we had noise around the correction through the pandemic. And I mentioned right at the start, you're going to get those sort of pullbacks that happen. It's a natural occurrence within markets. But we've been in a really decent run, really, if you look at it since the end of the GFC. And it's been facilitated by some fundamentals, big structural changes, effectively zero interest rates, or very close to zero interest rates, resulting in a lot more money going into the economy, which has been a huge stimulant, which has meant company earnings have expanded, which means share prices have moved higher. It's been easy for companies to expand because their borrowing costs were nothing to invest in their businesses, to become more efficient and grow. So that's been driving things. Then, obviously, things shifted. We've gone through a phase now where we've had interest rates tightening, which has really changed the shape of the market. And I think particularly when we look at the Australian economy versus the US, I think we're at a late stage within that cycle where we're potentially teetering on recession and a slowing economy. In the US, I think it's been managed in a very different way. And I think whilst there might be some signs the economy has been slowing there, I think that's a pause before we see that next run up there.
Got you. So two things that jump out at me just from your comments there. So really, the foundation of the economic environment that the country is in, and of course the corporate earnings growth on a company by company specific level. Yep. Two of those things improving where you've got GDP growth or gross domestic product and then earnings growth, that would probably deem your market to be in an expansion phase. How do you then determine when you're at peak? Because that's a question that everyone wants to know, right?
That's where we get paid the big
What are the
bucks,
signs?
Look, when we talk about peak, we typically talk about where the economy is booming and where the stock market. And there's a difference between what the stock market is doing and what the economy is doing. There's obviously a very marked difference there, and technically they should reflect the same thing, but they don't. when you get a peak in economic growth, what you will see, typically you might see a further push higher in the stock market, but what's running within the stock market has changed. And, if you look at different sectors of asset class, for example, energy typically is a late cycle performer. Utilities are fairly defensive and a late cycle performer, whereas technology tends to be at the earlier part of that economic expansion because it's really the technology that's creating the economic expansion in many instances. Pharmaceuticals, consumer discretionary is maybe slowing. Consumer staples pretty defensive and typically as well late cycle. So there's a distinction I think between the two. So what are you looking for when you're looking for that peak in the market? And the primary thing from a stock market investor perspective is, number one, how overvalued are the businesses that you're investing in, and where does the expectation sit for earnings growth? And this is a really good question if we look at the US. And I'll talk more to the US simply because that's where I do my investing. We've had a stock market which has been propelled ahead, as we've talked previously, by quite a narrow range of businesses. So there's another indicator that you're getting towards a peak, is that the market breadth, which is the technical term. I think we did a podcast called Bad Breath.
A long time ago.
6 months ago or something. You find that the overall market, the index, seems to be moving higher, which would suggest the stock market's doing well. But it's really being dominated by a very, very small number of companies. And we talked about the Magnificent Seven. Anything that's associated with artificial intelligence has done very well. And most other companies have probably struggled in the wake of that. So you've ended up with a market that's been propelled by not too much broadness across the economy. So there's the distinction I mentioned before between what's going on within the economy versus what's actually going on within the stock market. So they're different. So bad breadth is a very, very good indication that you're getting near the peak. Secondly is valuations, which are at historically high levels. Now, we saw prior to the most recent sell-off, a company's price was around about 24, more in some instances, but on average across the index about 24 or 25 times its annual earnings. So what that effectively means is you've got to hold the company for 25 years in order for it, or 25 earnings cycles, should I say, in order to get the company paid off net cash flow free. Historically, that's very high. 18, 19 is probably the number where that sits. So if you imagine an elastic band has been stretched too much in one direction, it's probably going to snap back, which we saw in the recent sell-off. Stocks are still overvalued a little bit. They're not good value. They're not cheap at the moment. So what would make you want to get in? Number one, they're sufficiently cheap to tantalize you, to tease you into wanting to buy them because it's a bargain, like the bargain bin at the shop. But you've also still got to have an expectation that there's going to be some growth down the line. Otherwise, you're just buying something that's in the sale that's going to effectively do nothing. So you've got to look at, okay, why has the valuation become cheaper to attract me? Is it a one-off factor, like a piece of economic data or commentary around interest rates? And is there a pathway out of this in terms of earnings growth? If there's no pathway out, if you don't see where the earnings growth is going and the economy is slowing and there's been a pullback, well, that is peak. You don't want to be going in there. You want to be buying more defensive assets, so utilities typically outperform pharmaceuticals, those sort of stocks, or looking for other alternate strategies like being bearish or going into a totally different asset class, maybe into bonds, for example.
I guess that's probably been the challenge for anyone trading markets more actively recently, is that we have had stretched valuations on a lot of these companies, but up until recently...
And they were delivering.
They were delivering. And now we've got to make our minds up as to whether or not we think these companies can keep delivering on their earnings. And they aren't necessarily priced in the traditional way. They're priced for growth, which has made things a little bit more murky.
Yeah, and it's a great point you raise. I mean, how do you assess what the impact of AI is going to be
in 10 years' time on the video? Very hard.
And it could be a total game changer, or it could be just a fizzer. And probably an example of a fizzer, like if you think about Meta, Facebook, the company we've all got a love-hate relationship with, the big growth area for Meta 2 years ago was going to be the metaverse, and they're piling in billions of dollars of R&D. Where's that? I haven't heard it mentioned for 12 months. What I've heard now mentioned is AI. So there's an example where Facebook was on an absolute charge, and then when you look at the earnings of the business, you go, okay, well, they're spending billions over here. The advertising spend has slowed down because maybe the economy slowed a little bit. All of a sudden, there's a bit of a stretch in the valuation. It's overpriced, and indeed, its share price dropped like a stone, only to then find its next thing to hold on to, being
That's
AI,
right.
and take off and hit the moon. So, you've got to lift the bonnet a little bit there, which is a challenge for a lot of investors. And it leads to whether you have a long-term view or whether you're trying to time the market. So we've talked about phases, the big fundamental economics. We've talked about cycle and where we are potentially within the cycle. And then within that, there are still trends. So depending on the time frame that you might have as an investor, trading shorter term trends can be extremely lucrative, especially after a big sell-off. And the questions still stand. What are the fundamentals for the economy? What do the valuations look like for the business? Where's the earnings growth coming from? But if you're trading in the shorter term, those factors are far less relevant for you because you're using much more charting and technical analysis in your decision making, in which case you're looking for a dead cat bounce or a key reversal for a period of time. In which case the fundamentals play a far smaller role in your decision making. So, there are a lot of different ways of approaching it. Trends, easy to trade, but require a high level of skill. Trading the big cycles in the market, much less skill required. What you do require is patience, and you need the willpower to let your money do its thing and not interfere with it by trying to trade when you should just be letting the trend take your money and make it grow.
Well, let's draw on that advice. So if we can draw some lessons from history, as I know you've been around the block many times, AB, you're pretty old. So in regards to lessons from history, where are we currently at now, to your mind, and what have we seen in the past in your lengthy career?
Look, I think we're towards if we look at the really, really big cycle for the US, I think we're towards the top of that, plus or minus 2 or 3 years.
Okay.
Because it's a big cycle, you can't say, we're at the top, it's finishing tomorrow. I'd say plus or minus 2 or 3 years. Some of the determinants for that view that I hold, number one will be the election outcome this year. And I have a fairly clear map in my mind that if we see a Republican win, that cycle will extend out further.
Due to favourable fundamental economic environment for companies,
Very
right?
much so, because
lower tax rates, things like that.
The whole phase is driven by fundamentals. So if you reduce company tax rates, for example,
more spending,
and introduce tariffs, be more defensive about your economy, get your unemployment down, manufacture stuff at home.
That's all good things.
Which are all the sort of mandates, I guess, that we're seeing as being election points from the Republican Party. It's a little harder to commentate on that from the Democrats' perspective because there simply aren't any policies that have been put forward. But traditionally, a Republican government would be, I would argue, probably better for that big phase going through. So that's one way of really looking at that. But you've also then got to look at what else is going on in the world too that could potentially disrupt that. And China continues to grow in terms of its economic and military might, and with that growth in economic might, it's kind of knocking on the door of the US to challenge the US's status as being the world's largest economy on a lot of different metrics. And again, China's got its own internal problems at the moment where it's trying to stave off the deflationary environment. It's got demographic challenges amongst other things, and so if it's able to traverse those economic challenges and stay strong at a time when maybe the US might be a little bit weaker, that transition of power would speed up an end to that bullish phase, I think, for the US. So that's kind of where I see that right now. I think it's hard to see between now and November smooth sailing. Not because there's just an election this year, but we're moving into that typically more choppy time of year from a seasonal perspective. September, October, particularly September, typically is one of the weaker months on record. Yeah, August can be very strong. So, you've got to tiptoe your way through that. If you're a trend trader, there's money to be made both sides of that. If you're looking at where we are in the cycle, then you've got to expect a level of volatility. I also think that even though we've had something of a pullback right now, valuations aren't bargain basement enough to want to attract you into equities. So if I consider where I've got my portfolio structured, my single biggest position right now is in bonds, where I've bought exposure to US Treasuries on the basis that if we see interest rate cuts, which I think everyone is expecting over the next month or so, that drop in yield will mean that bond prices move higher. So I'm not going to, careful how I word this, it's like I always look at gateways. If you've got a really big wide gateway, let's imagine you've got to try and reverse a trailer through a gateway, and having a farm, and that's something I have to do from time to time. If that gateway is nice and wide, you're going to get through it unscathed. But if it's quite narrow, it's going to be touch and go whether you scrape the trailer or the side of the car up against it, right? if you think about trading and investing, if you're able to give yourself really big, wide gateways that you can get through unharmed, and that's the term I would use here, that's what I like. So at the moment, in terms of the portfolio structuring I have, equities I feel still may be a little overvalued and not looking overly attractive because it's been a very narrow breadth in the market. We're towards the back end of the major phase. The shift from maybe technology as the door gets knocked to say, well, where is the earnings growth coming from AI? It's not there. So maybe there's a sell-off on those stocks and a repatriation of funds into other more defensive holdings at the end of the cycle, like utilities, for example. It is a challenging environment. And that gateway is quite narrow. And I've been doing this for a really long time. And the way to make money is, if it's a narrow gateway, you make a lot of money, but your probability of being right is much, much smaller. I'd like a really high probability of being right. So I'm trying to find investment opportunities that have a really good tailwind. And if my view of where we are in the big phase and the subsequent cycle is right, then I think for me, bonds make an awful lot of sense. I'm not a bond holder as a bond investor to get income from it. I'm just looking for that capital move. I've got a very geared exposure to US Treasuries. And when we start to see interest rate cuts and yields come down, bond prices, Treasury prices will take off. And I'm hoping that will be a very lucrative trade.
Indeed. And as you say, a lot going on. I know firsthand from trading markets every day.
You could be a hero. You guys day in and day out are talking to clients. You're on the front line. And it's not an easy role for anyone sort of sitting at home going, oh, you guys sit in the ivory tower and, house makes money irrespective. It's a very difficult job because we're invested with our clients, both emotionally and financially too. And you can go from being a hero for 5 minutes to a fool the next. That's how quickly markets can really shift, and that's an emotional roller coaster for you guys from a professional perspective too. It's really, really tough.
Sell-offs are my favourite. I always feel really good after those.
Well, again, you sort of draw back into what's the view? Where do you go from here? What's the long term? And if you really take a bit of perspective and step back, the long-term view when it comes to markets is always bullish because people by their disposition are inherently optimistic, or at least most people you'd like to think are optimistic about the future. And the stock market is a financial reflection of the emotional roller coaster that people live on.
There's an upwards bias to the market. We know that long-term.
Long-term, there will be an upward bias as we've seen from day dot. The challenge is that sometimes that upward bias goes through its correction phase, and so being nimble, being able to make money in a short trade, and look, if your view is that, and I see this on social media a lot with our advertising. That's my knees clicking.
I heard that. Almost as bad as mine.
Well, your excuse is you ran a marathon yesterday, so you should be looking pretty fresh, actually, I've got to say. Talk about long-term view. How does that 42K feel?
I'll tell you what, that's the beauty of the lights, the cameras here, Amy, because I sure as hell don't feel like it.
So, if you look at, where people see things and sell-offs, I see it on our social media account all the time. People go, there's a correction coming, the big sell-off's about to happen. And the first question I ask people when they post that on the feed is, great, how are you positioned short yet? None of them are. They're all experts. Oh yeah, it's going to crash. And look, markets do crash. As to when, well, a broken watch is right twice a day. And if you keep saying it's going to crash, one day you'll be right. But if your view is it's going to crash, you've got to profit from that. You always have to seek to profit from your view because it's an enormous validation, confidence builder, financial asset builder, and so on and so forth. So getting short the market isn't that hard. You can buy a bearish ETF. So if you buy SH, for example, which is the short S&P, or what do we got, PSQ for the NASDAQ, SQQ. There are a whole myriad.
Bear on the Aussie, BBOZ, there's heaps.
So there are plenty of ways to profit from a correction if that's your view. But have a view. Don't be an armchair critic. Go, I bet it's going to crash. Well, if that's the case, get short, make some money. Put your money where your mouth is because talk's cheap, money buys the whiskey.
That's right.
But I think long term, these are just things that pass by, and you look at opportunities, on everyday stocks. I remember, when through the GFC and other periods of time where you've sort of seen stocks like BHP at $16, and then at $140, and everything in between. And so having the confidence to go, okay, that's a value level that if I'm prepared to be patient with no skills, just backing myself. Just to buy and hold long term, you're going to be better off than someone that sat on the sidelines poking you in the ribs going, but it's going to crash. But they never do it. They're just talkers, so it's good. You just got to screen those people out. But having the confidence to step in and go, that's in the bargain basement, I'll buy that. Same with CBA. I remember, and it's up in the 120s, 130s. And yet you're thinking, 18 months, 2 years ago when it was $80, that's a pretty good price, good time to wash out of it. And looking at the chart on reflection, and this is the challenge, hindsight is a great thing. Every time you look back at someone with hindsight, you go, oh, look at that, you can see that, you can see that, you can see that. It's obvious. How can we do it? But in the cool light of day, when you're trying to make these decisions daily, when you're looking at what's going on at the news inputs or the chart movements or whatever the general sentiment in the economy or the political environment, really, really hard to be objective. So building a process where you know what lane you're in. And if you're a long-term investor, buying on these dips makes perfect sense. If you're someone because you're trading the full phase, the full cycle. If you're someone that's a trend trader and you're much shorter term, trading the short-term moves in the market up or down is going to make sense to you. But don't try and dance to somebody else's song. Find your little niche and get stuck into it. And don't overanalyze, because you'll sit there and do nothing.
It's really good advice, and I think it comes down to a couple of key things, as you say: corporate earnings, fundamentals around the economy. Most importantly, taking a longer term view, because as you say, cycles, phases, these aren't day to day, these are sustained periods, and understanding that time as your ally is so important.
Absolutely. And you can always argue for not getting in, in just the same way you've got to argue for getting in. And if you've got that optimistic disposition, it's about looking for ways to get in and profit from it rather than talking yourself out of it because, this could happen. Yeah, anything could happen. But what if it doesn't? And you're sat there in cash in 2 years' time in a high inflation environment that we're in right now, and the cost of a house has gone up another 30%, and your cash is worth less than what you had 2 years ago in terms of what you can buy with it. That would be a shameful place to be. And if you are someone that's bearish, you go, no, it's going to collapse, well, set yourself up and profit from that. If you're so emphatic that your view is right, trade your view. That's all you can do. And right or wrong, you'll have peace of mind of knowing that you can look at the man in the mirror and say, yeah, I did what I was supposed to do.
That's right. Indeed. Good advice, AB. Thank you very much for your insight today.
My pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button. We'll look forward to hosting you next week.